We're solely dedicated to the study and advocacy in the area and education in the area of state taxation, state and local tax. Our interface mainly is with the state tax departments of our members. They help inform us, and we help facilitate education among the members, and that's really the genesis for the research that you have electronically available to you and that I'm going to reference today. So I wanted to emphasize that the areas that COST looks at and that I want to discuss today are really focused on the areas that I think this, oh, we'll have it on the screen here. It's really the areas that I know this committee is interested in looking at to create a more fair and simple and structurally sound tax system to promote growth and competitiveness in the state. It's also, I want to emphasize, COST looks at areas of administration and where there's complexity in the tax code that can be addressed that are not necessarily revenue items for the state. So it's really a good opportunity to have this group here together, and we can talk about some areas that our corporate members in the tax department have seen as troublesome that can be reformed as part of a larger effort to take a look at the tax code that are not necessarily areas that are going to cost the state significant revenue. Obviously, there's the revenue replacement question, which is always the elephant in the room when you look at historic tax structures that have significant revenue impact if they were either diminished, phased out, or entirely repealed. So this is the areas I was going to look at today. I'd like to step first into our business tax burden study. I think Tax Foundation may have referenced this study in the last session. But what it is an effort by COST undertaken under contract by Ernst & Young to look at the total contribution of businesses across the country to each state's tax revenue structure, it's state and local. And what you see here underscored is that you have a national average of business contribution to state and local revenue of about 45%. That's national average. West Virginia's average is a little over 50%. It's 50.5%. So that is the total contribution of state and local revenue by business in West Virginia. If you look at the categories, not surprisingly, property tax is a very large percentage, followed by severance, local gross receipts, and excise taxes. Sales tax is a relatively small percentage compared to other states. I think the average is more like 20 in other states. And the corporate income tax, similar to other states, is pretty low. So this is the percentage of total state and local business taxes that is the corporate income tax represents. I think Tax Foundation referenced that in the last section. 9% is the U.S. average. So you could say as a total percentage of the state and local tax burden on business, corporate income tax is a little lower in West Virginia than it is as an average across the country. That's very interesting given this is for the last fiscal year in which the data was available. We'll be coming out with a new study this summer for fiscal year 2014. But it's interesting given that West Virginia, as part of the last significant tax restructuring, went to combined reporting and some of the other rules that were referenced in the last session, essentially to look at income shifting, closing loopholes, et cetera, to shore up the corporate income tax. To query whether that really was the issue, given that the corporate income tax is still a relatively low percentage of the total business tax burden. And it also raises the issue, as I go through some of the issues that we see with the corporate income tax that our members have raised, whether the additional complexity that came along with the last restructuring of the corporate income tax is worth it from the standpoint of the administrative costs for the state and also for the compliance costs for corporate taxpayers. Also like to underscore a few other data points here. The thing about when you get a business tax burden number, you can use that as one way of looking at a number of facets of the economy and state spending. For example, if you take the total amount of business taxes and calculate that as a percentage of the gross state product, so the business tax burden relative to the economy, you see that West Virginia has a 6% rate, which is actually higher than the national average. Now, if you look at our complete study, which is in your materials, the natural resource rich states tend to score higher, and that's as a function of the taxation of that industry. So I wouldn't say it's necessarily out of line. Another way to look at business taxation is the tax benefit ratio. This is, I have to admit, a very arbitrary measure in that you're looking at total government spending, and you have to assign what percentage of that government spending accrues to business taxpayers as opposed to individuals. And I'd say as a general rule, the study takes this kind of 50-50 rough cut, 50% benefiting individuals, 50% benefiting businesses, including for education. So if you assume that 50% of education spending benefits businesses and 50% of most other spending benefits businesses, you come with a ratio of $1.40 of business tax for $1 of benefit to business. And that is, I think, helpful. I know it's arbitrary to assign state spending and local spending to business benefit, but if you even take 50%, which is probably erring on the side of assigning too much benefit to business, you still have a tax benefit ratio over 1-to-1 and over the national average. Sometimes helpful when thinking of whether businesses pay their fair share of tax in a state. So that's one useful way of using that information. So now I'd like to move into the specific tax areas where COST has conducted research, where we have received feedback from our members, and we've seen trends on a nationwide basis, and I want to share that experience with you. First, generally, as you've heard, I think you heard in the last committee meeting before this, the corporate, and you heard earlier today from Tax Foundation, corporate income tax is the most volatile tax in terms of being a revenue stream for the state. Highly cyclical. There are loss carry forwards like other states. West Virginia generally conforms to federal, at least in terms of the carry forward. So in down economy, you're going to have a substantial downturn in corporate income tax revenue flow. Corporate income tax is also seen as the most complex in terms of administration, in terms of proportional to the revenue that it raises in using the state's valuable and limited tax administration dollars in terms of compliance and also in terms of audit. So on the state side and on the business side, an inordinate amount of resources are expended in administration, compliance, and controversy with respect to the corporate income tax. Now, there are winners and losers in the corporate income tax regime, specifically in the change to combined reporting, magnified that effect where you have profitable entities and activities outside the state that are brought into a combined corporate return. That impact is somewhat mitigated by a lower rate. So whereas an enterprise that is investing in West Virginia, experiencing losses in West Virginia, you have profitable entities outside the state brought in, and it creates an artificially large pot for apportioning to the state. That negative impact for that business investing in West Virginia is mitigated by the lower tax rate. So that was a significant plus in terms of a trade-off in the last round of significant tax restructuring. Now, COST has a policy position against combined reporting, and it's something that we've spoken to in a number of states, where we've spoken to separate entity return states and have advanced the proposition that combined reporting does not solve concerns with income shifting. because you still have the question within the combined group of whether an entity should be included in that group or not. And I believe that's something that West Virginia is wrestling with right now in implementing the combined reporting regime. But putting that aside, there were certain elements of the last tax restructuring with respect to the corporate income tax that I wanted to emphasize to this committee today, and I think are worth a look because they probably aren't bringing in any money today. And I know with respect to some of them, they're fueling controversy today that is in audit, which could end up in litigation. So just to underscore a few of them, the tax haven provision. This is relatively rare provision. It's included in the Multi-State Tax Commission's model combined reporting statute, which I think is how it became included in the West Virginia combined reporting statute. But what it does is it provides a set of indicators of foreign nations that might be deemed to be facilitating the shifting of artificial shifting of income to be a tax haven to protect that income from U.S. taxation. What the West Virginia statute allows is the commissioner on a discretionary basis to include income from an affiliate incorporated in the deemed tax haven jurisdiction and include it in the West Virginia combined return. I know from several members that this is a live audit issue in West Virginia, where the West Virginia Department of Revenue is asserting that certain foreign affiliates should be included, but it's not clear what the tax haven list might be. So there isn't certainty with regard to which entities are included in the return. It encourages taxpayers when they file their return not to include any entities because they don't know what a tax haven jurisdiction is. And then on audit, it encourages the controversy where certain profitable entities are going to be included in the proposed assessment. So our recommendation would be to repeal the tax haven provision. Again, I couldn't answer a question with respect to how much revenue. My guess is none right now. Whether through the audit and litigation process, West Virginia may end up with positive revenue from that provision remains to be seen. I would note that taxpayers have the option to include loss entities from jurisdictions to offset, and then there is always the potential for taxpayers actually using those provisions to their advantage. But from our perspective, the tax haven provision is one that underscores uncertainty in the West Virginia tax code for very little benefit. And as I noted, the change to combined reporting and all these provisions in here buttressing the corporate income tax, I think were intended to create sort of a fail-safe corporate regime without loopholes, has not had an appreciable effect from what I've seen in terms of the numbers that were presented at the last committee meeting. The corporate income tax remains very volatile and overall a very low percentage of West Virginia's take from businesses. Underscore a few other areas of the corporate income tax of concern. I mentioned the unitary group concept. That's inherent in the combined reporting regime. It's a constitutional standard, and that can't be escaped. So that's part of the regime that you have now, and it's why we urge caution when states are looking at combined reporting, because businesses, when they file their returns, are going to take the most advantageous position to them in terms of including entities that have losses. And if there's a profitable entity, if there's an arguable position that is not unitary, they're going to exclude that. And the Revenue Commissioner is going to come in on audit and include those profitable entities, assert them as unitary. And that's where the controversy arises. And it's something that every combined reporting state deals with. Also want to underscore, I mentioned the commissioner discretion with respect to the tax haven entities. To the extent that the commissioner is provided with discretion to adjust factors and to include entities, it increases the likelihood of disputes with the taxpayer. And this goes to the burden of proof, which is something I'd like to talk to a little bit later with respect to administrative matters with the state. But there should be a level playing field between the taxpayer and the revenue department in terms of burden of proof and whether the return was accurately filed. Also want to note about related party expense AdBack. So this is a fairly common technique among separate entity states to address perceived problems with income shifting. And what it does is it takes intangible or interest expenses. Those kind of payments you can make to an out-of-state entity or a foreign entity without potentially a substantial economic substance in their operations, and shift money outside the state. So the majority of separate entity states have adopted this related party expense add-back provision. What's unusual in West Virginia is West Virginia then went to combined reporting, which combines all the income, at least up to the water's edge, of all the entities. So any intercompany is included because you have the total income of all the entities, and there's adjustments for intercompany transactions. To my knowledge, the AdBack statute has not been synced with the combined reporting statute. I think administratively it has, but under the law, the corporate taxpayer is required to add back intercompany expense, yet at the same time combine the income. And I think administratively that's taken care of, but it's not in the law. And so that's an area that I think in any recommendations around the corporate tax, that specific item should be addressed. One thing you might look at is just repealing the add back overall, because you have combined reporting already. It's additional complexity. Obviously, intercompany interest expense, very common item. Query whether you really want to require the taxpayer to determine whether the add back applies every year they file the return when you have a combined reporting statute already. So Joe and the Tax Foundation referenced the throw-out rule in the earlier session. I think Joe gave you a pretty useful definition of it. What it does is it throws, when you apportion income, you use double-weighted sales factor here now. Throw-out rule says if you're not taxable in another state, you're going to throw those receipts out of the denominator. It shrinks the pie. And because of that, the West Virginia portion becomes larger, irrespective of any additional activity in West Virginia. So it increases the West Virginia liability without any relation to the amount of activity undertaken in West Virginia. It's contrary to why you heavily weight the sales factor, because you want to incentivize property and payroll coming into your state. You want jobs and investment in your state. To the extent that the sales factor is increased, the numerator that increases your apportionment percentage, by the sales factor throw-out rule, you're actually increasing the tax liability of in-state companies based on their out-of-state activities. Really counter to what you want to do in terms of using the sales factor as an incentive for in-state investment. Joe noted that only Maine has the throw-out rule in addition to West Virginia. New Jersey had it and repealed it, and that was after litigation. Made it clear that it was susceptible to constitutional challenge because of being out of proportion to the in-state activity. And also with respect to economic nexus, which is something West Virginia has and has asserted successfully to a large degree. Because what throw-out does is it says if you're not taxable in another state, we're going to throw those receipts out of the denominator and increase your West Virginia apportionment percentage. What the New Jersey tax court found, and I believe was upheld on appeal, was that if you do that constitutionally, you have to apply your own economic nexus standard to those other states, which means if you're going to say a company is subject to tax in West Virginia based on economic activity, you have to apply that same standard to the other states and not throw out the receipts. So there's an example of a rule you put in place, but ultimately could be thrown out through litigation. And I'd suggest that it very well could be, based on the New Jersey experience. I want to speak briefly about the sales and use taxes, another area of significant concern and study by our members. And it's interesting, given that the corporate tax is such a low percentage of the total tax burden on businesses at the state and local level, not just West Virginia, but around the country, yet it sucks up such amount of corporate resources. And part of that is its prominent role within the company. It's a prominent role at the federal level, and it becomes a prominent role at the state level within the company and the tax department. When you look at the total burden, actually, around the country, this isn't the case in West Virginia, but in general, because of the severance taxes, but in general, the number one, and the property tax, number one revenue source for the state level around the country is sales tax from businesses. And that's not pass-through, it's the actual burden on the businesses. Businesses pay a lot of sales tax around the country on their business inputs. The good news from West Virginia's perspective, and as you're all looking at this, is that West Virginia is second best in terms of imposing their sales tax on business inputs. So you actually impose the tax on businesses' purchases much less than most every other state. And that's a very good thing for a number of reasons. So you're around 30%. Some states are over 50% of the sales tax, the total sales tax coming from businesses, which is amazing, in that the sales tax is designed to be a retail tax. And as you know, around the world, there's a value-added tax, in the industrialized world, and otherwise very much spreading. But the same idea is that you're taxing final consumption. And the reason for that is, to the extent you don't tax final consumption, but you're taxing the intermediate steps of transactions, or of the flow of products and of services, you're creating the potential for tax pyramiding. So in those industries where there are a number of steps to bringing a good or a service to market, you're going to result in disproportionate tax burden, many multiple layers of the sales tax. This it results in a hidden tax to the consumer. So in the value-added regime, you get a credit forward at each step, and the end consumer just pays one rate, and there's no embedded tax. But when you have a sales tax and multiple points in the flow of commerce, you have this pyramiding effect, and it gets embedded in the final price to the consumer. It is a hidden tax, and it is passed forward. It's not a tax on profit. It becomes embedded in the price of the good or service that West Virginians pay. It increases the cost of living in the state, ultimately to the consumer, and it increases the cost of doing business for those selling both inside and outside the state. It also, and I won't belabor this point too much because West Virginia is doing a good job in this respect relative to other states, it creates the incentive, especially when you look at multi-state, it creates the incentive to locate your purchasing function outside the state. So to the extent that especially a service, which generally are not subject to tax around the country on a broad basis, to the extent a service can be purchased outside the state, or there's a manufacturing exemption that's available outside the state, you're incentivizing the purchasing function to locate outside the state. And that is a direct incentive to invest in the low tax jurisdiction where there isn't tax on the business input. So it is an anti-competitive thing to have business-to-business taxation. Another area another point against business-to-business taxes is actually disproportionately impacts small business, because a large business can vertically integrate to the extent that they can. A small business is much less likely to be able to do so. So the small business is going to shoulder the burden of that cascading tax, whereas large business may be able to actually escape that or be able to locate outside the state because they have the resources and the options to do so. So I'd like to underscore, as I said, West Virginia is relatively low in terms of imposing their tax on business inputs. But when you look at a tax expenditure report and you see various exemptions, Please examine whether those exemptions or areas of taxability for services that aren't currently subject to tax are generally consumer purchases, and if they aren't, consider providing a business-to-business sale exemption, understanding that ultimately the ultimate sale to the consumer is going to be subject to tax, and that's how the retail sales tax is supposed to work. So in our view, and I think across the spectrum of tax professionals, see a business-to-business exemption not as a tax expenditure because it's part of the normal operation of the retail sales tax. If it weren't, it would be more of a gross receipts tax because you'd be taxing receipts at every level. I also wanted to underscore regarding the sales and use tax, the good work that West Virginia is doing in being involved, continuing to be involved with the Streamline Sales and Use Tax Project. As you all are aware, the Streamline Sales and Use Tax Agreement has almost half the states as participating members, and there's a lot of talk about what an ultimate federal solution might be in terms of an online sales bill. But the work done on the Streamline Sales Project, and this is something that I was involved in for over more than a decade with PricewaterhouseCoopers before I joined Counsel on State Taxation, the benefits accrue to all businesses and to the state because it creates a simpler mechanism for administering the sales and use tax. It leverages economies across states such as a uniform exemption certificate, which is hugely beneficial. I can't underscore enough how, for a multi-state business, how important that is and how beneficial it is for your in-state businesses that are purchasing to be able to give a uniform exemption certificate to a multi-state seller. And it makes commerce so much easier. And so I'd like to underscore that this is a project worth continuing to pursue. From cost perspective, we have a policy statement in favor of a level playing field for online and in-store sales, but we also urge states to work together to create simplification so that the compliance burden isn't inordinately high. And that's what the Streamline Sales Tax Project is intended to do. So we encourage the committee to support the Streamline Project going forward, and especially the current efforts there in the Streamline Project to look at best practices for member states. This is an area where states provide to the business collector of the sales tax information regarding taxability, what the exemptions are, and hold them harmless for using that information. It's very important that your voluntary taxpayer collector, which is the business collecting your sales tax, know what the rules are. So we very much encourage continuing participation in those efforts. Okay, regarding tax administration, we have a scorecard system. So Tax Foundation has rankings on competitiveness and all, and we have a scorecard system on administration. And the purpose isn't to, give bad grades or anything like that. It's to provide, I think as Joe said on their Tax Foundation's rankings, to provide a set of metrics so that states can see where they rank, but also where they can improve in certain areas. And our tax administration scorecard, I think West Virginia has a grade of B on there, is excellent. But the intent is to provide some areas of fairness for committees like this to look at, common sense areas where we think, in general, even revenue departments and the taxpayer would be on the same page, and the legislature can facilitate a simplification effort that's to the benefit of everyone. So, for example, an equal interest rate on overpayments and underpayments. So you don't have the process of whether you're going to pay first and protest or not pay be influenced by high interest rates. Because the interest rate should just be for the time value of money. It's not a penalty. There are penalty provisions, but interest rate should be for the time value of money. The underpayment rate in West Virginia is statutorily set at a minimum of 9.5%, which is not indicative of the time value of money in today's investment return rates. The overpayment rate is actually 8%, which is extremely high too. So we'd suggest making them equal and making them much lower. Should really reflect the time value of money. Number of states tie it to the prime rate plus whatever, but certainly not 9.5%. That's an outlier. There are others that do it. There are some that do it for revenue-raising purposes. I suggest that with 1.5% spread there, without significant revenue impact, it could be equal and much lower. It may end up saving the state money, but it's certainly something to look at. The corporate return filing burden. Here's something else that really should not make any difference one way or the other to the Revenue Department, but would really be significant for helping taxpayers. A number of states have the corporate return due date 30 days after the federal, because the federal return's massive in many cases, and what's more, you have a combined report in West Virginia, and they even require to look at potential tax haven entities. All that to be due on the same due date, including the extended due date, as the federal return is insufficient time, because the state tax department could be filing all over the country, is going to get the federal return very close to the last minute oftentimes. So to get a better return, I suggest providing the 30-day additional period, which a lot of states do as an automatic extension beyond the federal due date. Determining when a taxpayer has to report federal changes. Again, for the large corporate taxpayers, you could have many entities that would have to report adjustments across the country. There needs to be a uniform definition of what the trigger is. So, as you know, at the federal audit, in the federal audit process, there are a number of points at which you could call the audit final. And for West Virginia to specify what the final determination is for federal purposes that triggers the West Virginia reporting requirement would be very useful. And all that is saying, when do you have to report it? Because the corporate taxpayer, looking at state compliance, sees no guidance regarding when that triggering event is from the IRS. So a final determination definition, we have a suggested definition. We're actually working with the Multi-State Tax Commission to try to, because they have some guidance in this area out there already, to provide a uniform definition for taxpayers to use, and we'd be happy to supply that definition to this committee. But then also provide sufficient time. We recommend 180 days to get all those amended returns into all the states. And a number of states have been moving in that direction. West Virginia has 90 days. We suggest moving to 180 days to provide the notice of federal change. Again, interest applies. This is time value of money, but you want to get quality returns, and you're asking for amended returns across the country for a complex corporate structure. I think it behooves the state to move to 180 days. We also added a transparency area in our scorecard. And again, this is an area where I think everyone can agree that there should be transparency in terms of guidance provided to taxpayers. It's our understanding that there aren't letter rulings published to the tax department website. There are private letter rulings. They could be redacted and published to the website. We'd encourage for that to happen. There's an area we scored across the states. And admittedly, there's practitioners in some states that don't want their ruling requests to become public. But to the extent that a ruling's been provided and it can be redacted, the state should do so that there isn't a secret law out there where some taxpayers are getting a better shake depending on who they're using. With transparency, there's none of those allegations because there's a determination by the tax department, and the next taxpayer that comes along is going to expect the same ruling. They're going to cite, even though it's not precedential, they'll cite the same reasoning and say, why aren't you applying it? So we think that's a best practice that West Virginia should adopt. Now, in the area of property tax administration, this kind of bleeds into some of the other discussion, which are larger revenue items, like a de minimis exclusion for the business property tax, unequal assessment of business property versus individual property in terms of real property, interest rate differential. I understand it's much more pronounced for property taxes than it is for general tax administration. Those are all larger revenue items, but areas we encourage you to look at. Other areas that are more in the area of fairness, insufficient appeal period for local taxes, for property taxes. We think you can provide a more sufficient appeal period there. There's a clear and convincing burden of proof standard for property tax appeals, and that goes to leveling the playing field. So I'll give an example just overall in terms of tax administration. Arkansas just enacted a statute that provides for a very clear burden of proof and when it shifts, and it's a preponderance of the evidence, and the tax department has its burden of producing its assessment, it's reasonable, and the taxpayer has its burden of rebutting, and it's all spelled out in the statute by preponderance of the evidence. And we'd suggest that leveling the playing field in this respect is going to improve the process, and you're going to have more fairness in terms of the assessments, and you're also going to have more fairness in terms of the end result for the taxpayer. There's an inability to escrow or defer payment of disputed property tax. Again, this is an area where it's not going to ultimately cost the state anything, but then the taxpayer is not going to be required to pay the tax up front. So it's a taxpayer benefit that really shouldn't cost the state any substantial amount of revenue. Moving on to the area of unclaimed property. So this is an area where often there's very little discussion, and one of the reasons I wanted to highlight it. Because for cost members, unclaimed property can become a very substantial issue for the tax department because it's usually reported outside of the tax department, accounts payable, or some other department, but then the controversy ends up in the lap of the tax department. Now, unclaimed property simply, as you know, is property that is held by someone other than the owner, and then becomes dormant because of a lack of contact, and ultimately becomes escheated to the state. It gets reported over to the state. Unclaimed property, the reason for the unclaimed property regime is to reunite property with its owners, so that when you lose track of the actual owner, that owner, many years later, can go to the state treasurer and claim the property. And this is an area that I'm not singling out West Virginia, but across the country, we recommend these reforms to ensure that the purpose of unclaimed property law is being carried out in each state. One is to exempt business-to-business transactions. Our experience is that business-to-business transactions ultimately are not returned to an owner when that property is escheated to the state, and often becomes part of the revenue, general revenue for the state. Also, businesses are in the best position to determine whether another business actually owes them money. It's not a consumer protection situation. We advocate for an independent prepayment appeals process. So just like you have for tax, you should be able to go to an independent arbiter and appeal an assessment of unclaimed property. The same concept applies to unclaimed property, yet it's pretty rare around the country. But Missouri is an example of where their Administrative Hearing Commission just took jurisdiction by legislation to hear unclaimed property disputes. So there is an example. Contingent fee audit arrangements are very common because state treasurers generally are accustomed to auditing the in-state companies, but not the multi-state. They don't have the resources, so they contract out the audits. This has become an area of abuse around the country in terms of a very small number of third-party auditors entering into the lion's share of contingent fee arrangements with the states. So this auditor is incentivized to increase the amount of the assessment because that's how they're paid. It's not an hourly basis. It's not based on their costs. It's based on their take. And that fuels what we see and what our members see as audit abuses in these areas, where the ultimate goal is to force a settlement through a very lengthy multi-state unclaimed property audit. North Carolina barred contingent fee audits for unclaimed property. It's pretty rare to ban contingent fee audits because it's the main way that these audit contracts are structured, but I would posit that they can be structured in other ways, including based on the actual costs of the auditor in a way that doesn't incentivize an inflated assessment. So I'd encourage the committee to look at contingent fee audits in the area of unclaimed property. And with respect to gift card escheatment, and this is obviously particularly a retail area, but to the extent that a gift card is escheated to the state, so there's a gift card amount that isn't used, that revenue is never going to get returned to an owner. You don't even know who the owner is by its very nature. It's a gift to someone. So even if you captured the information of the person that bought it, which stores don't do, you wouldn't be able to return the gift card to the owner. So this is really an amount of revenue that goes to the state. I'd encourage the committee to look at, as a consumer protection area, the states that exempt gift cards, many of them provide that, okay, if you're not going to escheat the gift card amount, provide that there's no expiration date. And that way it can always be used by the holder. And that's a fair way to have a consumer protection, but at the same way not provide for an audit regime where you're going to go to retailers every audit cycle and say you didn't escheat the proper amount of gift cards and create general revenue out of what's supposed to be a consumer protection mechanism. So in closing here, and I'm not going to spend a lot of time on the business personal property tax and local B&O tax. You heard the prior speakers speak to that. And this is an area of particular research for cost. And it is also an area where you'll be challenged to make up the amount of any revenue. Just to point out, and we did a competitiveness study a number of years ago, I think it was 2009. So we haven't redone it, but it really states West Virginia scores low on it. It goes to, if you're investing as a new business or an expanding business, what are the costs? And obviously, if you have a business personal property tax and other states do not, and you have it on inventory and tangible property, then that next dollar of investment is going to be subject to tax, and it's going to disincentivize additional investment in the state. Same with the B&O tax. At the local level, it's gross receipts tax. It's irrespective of profitability. I would say that with respect to all of these, you could look at lowering compliance costs and leveling the playing field. So we're talking about the burden of proof on appeals and things of that nature. Local gross receipts tax, to the extent that they have complexity in compliance area, you could look at simplification there. Obviously, Ohio has a statewide gross receipts tax. One of the benefits of the statewide, at least, not that we would advocate for that because of the nature of gross receipts taxes in general being anti-competitive, is that it reduces complexity. You don't get that with a local B&O tax. So you have, like my home state of Virginia, the B-poll, it's a complex tax. It's an area of increasing controversy, and West Virginia could look at ways to simplify its B&O tax at least. And there are other areas where you could provide relief there, which Tax Foundation discussed earlier. So with that, those were the areas that I wanted to cover with you all today, and we're happy to answer any questions.